Good afternoon, everyone. Great to be with you again. Brad Macbeth here from The Simple Plan, and this is The Simple Plan Live. Today, we're going to have a look at how you can make some assessments about investments. People are often looking at ways to think about how their investments are performing and such. And so we're just going to look at some basic questions about what should I be thinking of when I'm looking at investing. And we're going to look today particularly at funds, mutual fund types of investments, and just look at how some of the different types of information you get about funds and how to compare them and how to think about them. And I want to let you know that today is brought to you by our sponsor, which is the Simple Plan Life Insurance. You can get your own custom quote at www.getthesimpleplan.com/quotes, and you can get rates from all major Canadian insurers there. Also, if you're not sure how much life insurance you need, you can get a calculation right there of how much insurance you should have. That's at www.getthesimpleplan.com/how-much. All right, so we're going to have a look at some different investments today. We're going to compare a few here and there. I'll show you a couple of tools and how to do a bit of analysis just to get you thinking about the factors that help you to determine how you want to be investing. And you want to know this. Of course, I highly encourage you, as most financial experts will, that it can be really good if you're working with an advisor. Stats show that you'll do better with an advisor than without. And we'll take a look at that one day as well. We'll dig deep into that. But so obviously, I'm looking at this from an advisor point of view, and I'm going to show you a few funds that we use with our typical clients. And so there's also a helpful article you can consult. This is basic information, so if you're starting out investing, it could be helpful to you. If you're a more sophisticated investor already, then it's probably not for you, but it's called the ABCs of Investing in Under 5 Minutes. You can get it at bit.ly/ABC5mins, all capital letters. That's bit.ly/ABC5mins, all capital letters. And so let's switch over now, and I'm going to share my screen here with you and show you some information that we're very accustomed to dealing with. So what I'm going to show you here is the performance information that just came out for 3 different funds. These are all through a robo-advisor that we use with clients called WealthBar. And there's different types of funds. Let's just get that lined up there for you nicely. And I think we want to view that at the visible. So it's a little bigger. There we go. Okay, so this first one is called the Essential Aggressive Portfolio. And it is actually the portfolio that we use when we work with clients who are fans of Dave Ramsey. Or Financial Peace University, if you've heard of that. Dave Ramsey's a big financial guru out of the United States, the biggest one really, has some very solid advice on many topics. Big fan of Dave Ramsey. So a lot of the clients we work with are Dave Ramsey followers, and so we have sourced and looked for portfolios that emulate the kinds of advice that he gives about investing. And so this particular portfolio is called the Essential Aggressive Portfolio. It is 100% equities. So that means it's 100% stocks. There's no bonds in it. It's all stocks contained inside this portfolio. And this is actually an index fund. And it contains several underlying indexes. And it maps out at about 25%. Well, let's just go to the information and we'll look at it. So here we see first a graph at the beginning of the page that just lets you know how this thing is performed. This is, again, the May 31st information, so just hot off the presses. in the last few days. And so this shows you how this has performed over the last 5.5 years, which was when this portfolio came to be approximately. So you can see that we get all the way through here to May 31st, end of May 2020. And this maps the growth of $100,000 over about the last 5.5, almost 6 years, I guess. And so you can see that $100,000 would have grown to about $148,000, almost $150,000 at the end of May. Now, the interesting thing is, of course, we've just gone through a huge dip. You can see that highlighted right here. That's the dip that we've gone through since mid-February. It's been quite a bumpy ride there. But it gives you a sense of how this has performed. Okay, so let's go down and look at some of the information in the tables. So YTD, when you see that, means year to date. And so this first table is showing us the cumulative returns over longer periods of time. So for example, year to date, that just means the calendar year. So in 2020, this fund is done minus 5.71%, which for a 100% equity fund is not bad, all things considered. The last month, it's gone up 3.69%, which in the course of a month is quite long or quite large, because of course, if you map that over a 12-month period, that would put you at close to 40% on an annualized basis. You can see, different performance. Last 6 months, it's down 5.18%. All of that's kind of mildly interesting in that it gives you some sense of how it performs in a particular period when particular things are going on. We've had a big downturn. We have a pandemic going on. There's a lot of political unrest. And we've had a huge downturn in the stock market. We have massive unemployment. And also we've had a huge bounce back in the stock market. We talked about that last week when we were looking at indexes. So, but what you're going to be more interested in is longer periods of time. And so we have here the cumulative return. Well, actually, we want to look at the annualized returns. Once we get to a year or longer, we want the annualized returns. Annualized returns means the return it would give you year over year. So in 1 year, it's done 3.79%. Over 2 years, 1.37%. Over 3 years, 3.49%. So that's kind of sluggish performance. But again, a lot of that has to do with the more recent events. And then since inception, in this case, end of August 2014, so that means we're about 2 months shy of being 6 years of performance here. It has done 7.11%. Okay, so that gives you a sense of performance. You usually would have your own idea of what you might be expecting. I would say 7.11% is a little low for this fund, but then again, we're at the pointy end of some turbulence and a bit of a downturn. Now, interestingly, you can see calendar year returns. So these are the different returns that this fund did over the previous 5 years. So in 2019, it went up 16.64%. 2018, there was a down year. 2017, up 13.5%. 2016, up 9.5%. 2015, up 9.4%. And we would expect over a long period of time that this fund would probably perform around 8.5%, 9%, maybe 9.5%. This, where it says Global Fund, Canada Fund Global Equity Balanced, what that is about is that's an index. So what we're comparing is how has this fund performed compared to a certain particular index. Now, of course, this is just a fund of index funds, so it's a bit of an odd comparison because there's no active management going on in this fund. So, it's a bit of an odd comparison there, but it does show positively. And so the holdings in this particular fund are the Vanguard. It holds the Vanguard All Equity ETF portfolio. So that is just an index fund. Well, it's an index fund of funds. It's a portfolio that contains index funds that Vanguard operates. So costs on this are very low. You can see down in the bottom corner here, we've got portfolio MER is 0.22%. Now, that's not all that you would pay in fees for a fund such as this. You would be paying as well for what I call the platform fee, and we're going to do a comprehensive show on on fees in the near future. But you would expect to pay a platform fee, which means you're paying to be able to get access. You can't buy this directly from Vanguard, so you either go through an advisor, or if you're a do-it-yourself type investor, then you would have a fee that you would need to be paying someone like Questrade or Qtrade or what have you. So then we've got, we see the breakdown of this portfolio, and it is 39% U.S. equities, 30% Canadian equities, 23% international equities, 8% what are called emerging markets. So you've really got about 31% total international there. So it's actually a pretty good mix for a Canadian investor to hold. Some might say, well, I'd like a little less Canadian content, but I think that's a pretty good balance for a Canadian investor that's looking for a fairly aggressive approach. Anyway, I'm not shilling for this fund. I just wanted to give you an idea of how to think about the information that you get to analyze these funds. So that's just some very basic information on that particular one. So let's compare it if we go over to another fund called the Valet Growth Portfolio, which is the Valet Growth Portfolio is a mix of index funds and some actively managed funds that are primarily in real estate. And so again, you see how the performance has been. This is a different period of time because this fund started at a different time, though it's a fairly similar period of time. And if we go down, we'll see how's the growth been over calendar years. Well, 14.36, 1.09, 9.47, up and down a fair bit. This fund has more underlying holdings. It's a portfolio that's managed by a company called Nicola Wealth Management out of Vancouver. And so it contains a mix of index funds as well as a couple of actively managed funds, one of which is a real estate fund, that's that there, and one of which is a mortgage fund right there. And so those both are actively managed, as well as the mix or the combination of what's within this, the percentages of what's in this portfolio is also actively managed. So, we see here that it's got a bit of a different mix. It's 10% mortgages, 27.5% U.S. equities, 10% corporate bonds, 17.5% international equities, 20% real estate. And that real estate fund, by the way, is a fund that actually owns buildings. It's not a paper fund. It actually manages buildings. Canadian equities make up 10%, and then they've got 5% in high-yield bonds. So you've got 15% total in bonds there. And again, the portfolio MER is 0.52%. And again, you would add in there a platform fee and an advice fee. If you're working with an advisor, your advisor is going to get paid as well. And either that may be a part of your investment cost, or it may just be a fee that you pay directly to the advisor for his advice. And then finally, just one more example. This is called Private Pool Aggressive. This is a fund that these folks manage that is primarily aimed at wealthy investors, though they've put together a version that not as wealthy investors can get into at a low price point. And so it's a little more what we would call defensive. It is set up to preserve capital and get some growth, as opposed to more aggressively gain growth. And so you see that the ride on this is a little less up and down. It doesn't go down quite as much. So this fund, just looking, so again, this goes back to about 2014. And we see the range, the similar range of numbers. The numbers are lower, both on the annualized returns over here, as well as on the calendar year returns. And again, that's because it's more defensive. Let's go back and look at what it's done. So if we look at what it's done in the year to date, it's not down as much. It's up somewhat. It's up less in the last month. It's down less in the last 3 and 6 months. So again, there's that more defensive stance. And that, since inception of 7%, you probably would expect that out of a fund like this. So here's the interesting point on all this is it's not about comparing these 3 funds is definitely comparing apples and oranges. These funds are not designed to do the same things, each one of them. They're each designed differently. But you get the sense from looking at these different comparisons of how comparing takes place. So let's switch over now and have a look at a tool that we use that when we're trying to figure out, well, what do we want to go with in terms of selecting funds. So one of the things that we'll do is we often take a client or a prospective customer's existing portfolio and we then compare it with with other options and funds that might fit the kind of thing they're doing. So that way we can see, are they getting good performance and are they getting good value for their money? And by their money, I mean the money that they're paying for fees. And so here we look at, this is the growth of $10,000. Let's see what are our components. So yes, again, this is a tool that we use. So we've got 3 different components here. One is called Couch Potato, and it emulates a model portfolio that is advocated by a popular kind of self-investing author in Canada. Their portfolio is called the Couch Potato portfolio, the idea being that it's a fairly set-it-and-forget-it portfolio. And then we've got the Valet Growth portfolio, which is one that we looked at just when we were looking at our charts there a few moments ago. And then we've got the Vanguard S P 500 Index Etf, just to compare if you just went with a straight S&P 500 index fund, how you would do. And of course, the S&P 500 index, as we learned last week, is a big index that tracks the 500 of the larger or largest companies out of the United States. So let's go back up and look at the chart. We've got our 3 on here, our Couch Potato, our Valet Growth, and our Vanguard. And they're each different colors. And so our Vanguard is the green one that's had the higher performance. So we're looking at 5 years of performance here almost. Yeah, we are looking at 5 years of performance. Few things to note when we look at this. Obviously, this is about the growth of $10,000 again. And a few interesting points. First off, obviously the bigger result has come from the S&P 500 fund. It's grown by over 50% in that 5-year period, whereas the Couch Potato and the Valet Growth have each grown by about the same amount. So that's not necessarily a bad thing. It's not, people like to take an absolute number and just compare and say, hey, now I know which one I want. Well, maybe you do, maybe you don't. So let's look, for example, at the differences. Well, obviously the ride on the green is much more turbulent. There's much more up and down here on the green line. And you know what? I'm just going to turn this into a PDF so I don't keep getting those things popping up. Actually, no. I'll just leave it like that. I know that's going to cause a bit of issue. So if we look at the green line there, the green line, the highs are higher and the dips are deeper, right? So it's a much more bumpy and turbulent ride. Now it gets a better result, and that's what we would expect from a pure U.S. equity fund over a longer period of time. Now, I'm not saying 5 years is a longer period of time. It isn't. When I say longer periods of time, I'm talking minimum 5 years, but preferably 10 and 20. And so then when we look and compare the couch potato and the Valet growth fund, we see that over 5 years, they've really kind of tracked similarly and arrived at about the same place. The couch potato is a little more volatile. There's more up and down to it. And that's probably because the Valet growth portfolio contains real estate components, which don't fluctuate in the same way that the stock market does. So let's just say that we thought that what we were aiming for was a 7.5% rate of return. We can input that here, and it will show us how we're doing, right? So that's the dotted line if you'd had a 7% rate of return, or 7.5, sorry. So obviously our S&P 500 has outperformed that, and our other two have underperformed that. So let's see where we're at here on those other two. If we go, so if we go to about 6.3, 6.25, let's call it, that gets us to that's about the performance you've had out of those other funds. Now, again, everybody's numbers are down right now because of the up and down of the market recently. We're in a bit of a trough. All right, so when we go down to compare, again, we can compare our 1 and 3 year returns. I'm not going to get into the really technical stuff like beta, but I will get into management expense, which in this case, I just chose the most basic forms of these funds as if you were doing it yourself out of a platform like a Qtrade or a Questrade. So the only thing that you're paying for, and I haven't even factored in the cost for trading in there. So the MERs are quite low, but normally you would see different numbers here, and you'd be able to compare how much am I paying in fees for these portfolios versus what performance am I getting. And again, you can compare the returns. So we see over 3 years, couch potato is done 10.29. The Valet's done 9.14, and the S&P 500's done about 14.6. For some reason, our calendar year returns aren't populating there. I'm not sure why. Here's where it starts to get interesting in the comparison is what are these portfolios made up of? So your couch potato is about 30% Canadian equity versus 15% in the Valet growth versus 0 in the S&P 500, obviously. The S&P 500 is 100% U.S. equities. It says international equity there, but that's just probably about where some headquarters might be. So you're able to look at what am I wanting? Am I wanting more Canadian? Am I wanting more U.S., more international? Do I want bonds? I've got 15% in one, 10% in another, and that kind of thing. When we look at the top 5 equity industry holdings here, now we're comparing what's actually inside these things. Well, it's no surprise that when you find something that's more heavily weighted in Canadian content, so let me make sure I got my facts straight there. Yes, I do. So the couch potato is 30% Canadian content, which means there's a lot of financials in it. And financials are banks and insurance companies. And the reason for that is that forms a major portion of the Canadian economy, the financials. The challenge of the Canadian economy is it's really primarily 3 sectors. There's 3 major sectors to it. One is financials, so banks and insurance companies and similar. 2 is energy, which is oil and oil delivery systems. And then 3 is utilities. So that includes things like telecom companies, hydroelectric companies, that kind of stuff. And once you get beyond that, there aren't a lot of huge sectors that make up the Canadian economy. If you look at the S&P 500, it's more evenly balanced because it's all U.S. So you've got 22% technology, 18% financials, 13% consumer services, 12% healthcare. Healthcare is not a sector in Canada, right? Healthcare is primarily in government in Canada. 12% industrials, and so on. And so you get better diversification, and you can look for better diversification by going that route. Now, the Valet one, of course, is heavy in real estate because it's got both the mortgage fund and the real estate fund that comprise a straight 30%, as well as there being real estate and some of the other components. I'm not going to break down the risk ratings. You know, if you want to get really nerdy, you can get into this kind of stuff. You know, most of us don't think about things this way. You just want to really compare. You do want to compare, what am I getting for the risk I'm taking, right? So there's really two things that you're doing when you're making investment choices. You're selecting the level of risk, and you're selecting the amount of fee. And so you want to be asking yourself, okay, if I'm taking this much risk, am I going to get result? Number one. And number two, if I'm paying a higher fee, am I getting a higher result? And those are the two major questions that you want to keep your eye on when you're making your investment selections. The other thing is geographic distribution. Again, couch potato is about 40% Canada. The other two, one is 43% U.S. Of course, the S&P 500, as I said, is really 100% U.S. United States is second in the couch potato at 33%. Canada's 27% in the Valet portfolio. And then you find out where else the money goes: Japan, UK, China, that kind of thing. And then it gets to small distributions across a bunch of different countries. But those are really the major considerations that you want to be thinking about when you're making decisions, whether they're your direct decisions, you're an independent investor, so you're using a Q-Trade or a Questrade or a platform like that, or whether you're working with an advisor, because you want to understand the choices that you're making when you're working with an advisor. An advisor is going to help you make decisions, give you good options if they're good at what they do, but it's ultimately you that needs to be responsible for your finances, because you're the one that's going to have to live with the results over the long term. You're the one who's going to live in retirement. Your advisor will probably be retired as well by the time you get retired. And you're going to have to live with the results of that when you hit retirement. So you definitely want to understand what's going on. So I just wanted to take you through those two stages today. One is just kind of a basic look at what are we getting into when we make investment choices, and the other is looking at a direct comparison. And as I say, we do those kinds of direct comparisons all the time for clients. We'll take their existing portfolios and compare them to other options that kind of fit their choices about investments or their investment profile. And so it helps them to get a really good picture of whether they're getting value for their money and their risk. And so we're always happy to do that with people. You know, if you're interested, if you have some investments you'd like a comparative look at, get in touch. We're happy to help you out with that. Of course, you can find us on Facebook. You saw that before. You can track us on Twitter and on Instagram as well. There's those coordinates. And again, don't forget today's helpful article, The ABCs of Investing in Under 5 Minutes, a basic primer for those that are getting started and want to understand some fundamentals of investing. We want to thank our sponsor today, The Simple Plan Insurance. That's at www.getthesimpleplan.com/quotes. If you're looking to find out what it might cost you to get life insurance from all major Canadian insurers, you can just do that yourself right there in that. And if you need to know how much insurance that you need, you can go to getthesimpleplan.com/ how much and calculate how much coverage you should have to keep your family secure. Well, I'm Brad Macbeth. Thanks very much for listening today. We'll be back again on Friday. And in the meantime, take good care and take good care of your money. Thanks.